Imagine waking up at 3 o'clock in the morning to the sound of diesel engines and grinding metal right outside your bedroom window. You rush to the glass, pull back the blinds, and watch helplessly as a tow truck drags your vehicle out of your driveway and disappears into the dark. For 1.5 million American families last year, this was not a bad dream. It was a brutal, humiliating reality. And right now, in the middle of 2026, it is happening at a scale that is sending massive shockwaves directly into the heart of Wall Street. Welcome to the 2026 auto loan death spiral. We are watching the real-time collapse of the American car market, a crisis built on predatory lending, artificial inflation, and absolute corporate greed. If you think the economy is cooling down because the government tells you it is, you need to look at what is happening at the repo lots. Let us dive deeply into the unvarnished data. As of the end of 2025, American auto loan debt officially hit an astronomical $1.67 trillion, spread across 108 million open accounts. But the size of the debt is not the scary part, the terrifying part is how quickly it is going bad. In the first quarter of 2026, 90-day delinquencies, meaning people who have missed 3 straight months of car payments, reached 5.60%. To put that into perspective, the long-term historical average is only 3.59%. We are blowing past the danger zone. But if you want to see the true horror story, you have to look at the subprime market. These are the loans given to the working class, the people with lower credit scores who just need a reliable vehicle to get to their jobs. In January of 2026, the 60-day delinquency rate on subprime auto loans hit 6.9%. According to Fitch Ratings, that is the highest delinquency rate on record since the early 1990s. Let that sink in. We are seeing higher default rates today than we did during the darkest days of the 2008 Great Recession. And here is the paradox that is completely baffling mainstream economists: unemployment is sitting near 4%. The economy is technically producing jobs. People are not defaulting because they were fired, they are defaulting because the math has become fundamentally impossible. The pandemic-era savings cushion has been completely wiped out. Groceries are up, rent is up, insurance is up, and middle-class Americans are suddenly realizing that the $800 monthly payment they signed up for on a 72-month or 84-month auto loan is slowly starving their family. But the true epicenter of this ticking time bomb lies in a specific, highly predatory sector of the market known as buy here pay here dealerships. These are the lots that advertise guaranteed approval, no credit checks, and instant financing. They prey on desperation. The data on this sector is absolutely catastrophic. Buy here pay here loans have delinquency rates roughly 2.65 times higher than traditional lenders. Even worse, they are 16.63 times more likely to end up in active repossession. By the third quarter of 2025, roughly 5% of all balances in this sector were actively being hunted down by repo men. And this is where the crisis stops being just a problem for the poor and middle class and starts becoming a massive problem for the banking elites. This is not just theoretical anymore. Let me give you the smoking gun. In September of 2025, a major buy here pay here operator named Tricolor Holdings completely collapsed into bankruptcy amid massive allegations of fraud. When Tricolor went under, it did not just hurt the people who bought their cars, it blew a massive hole in the institutional banking sector, causing roughly $200 million in immediate losses to 2 major banks that had exposed themselves through credit lines. Wall Street bet heavily on the repo economy, and Wall Street got burned. The situation has become so severely toxic that in February of 2026, Senator Elizabeth Warren launched a massive congressional probe directly into auto lenders and their aggressive, predatory repossession practices. Now, I want to be completely honest and transparent with you, because this channel is built on hard facts, not blind panic. If you talk to mainstream industry analysts today, they will describe 2026 as a period of elevated stress, not a 2008-level systemic banking collapse. And mathematically, looking at the entire global banking structure, they are technically correct. This auto loan crisis is not going to bankrupt the entire United States government. But let me tell you something, if you are the father or mother who is standing on the sidewalk at 3 in the morning, watching the only vehicle you have to get to work being towed away because you had to choose between paying the car note or buying food for your children. It is absolutely 2008 for you. It is a total systemic collapse of your personal economy. A car is not a luxury in America. It is the only way to participate in the economy. When the repo truck shows up, the psychological hit is devastating. People feel a profound sense of failure, thinking, I worked hard, I did everything right, and I still lost my car. The anger in the middle class is boiling over because the class divide has never been more obvious. The wealthy are walking into dealerships and buying vehicles in cash, or they are leveraging relationship banking to secure a 3% interest rates. Meanwhile, the working class is being shoved into 14% to 20% subprime APRs on depreciating pieces of metal, locked into 84-month contracts where they will literally never build a single dollar of equity. So, how do you survive this? How do you protect yourself from the 2026 auto loan debt spiral? You cannot rely on congressional probes or bank regulations to save you. You must take extreme, aggressive ownership of your financial mechanics right now. Here is the exact, step-by-step masterclass on how to navigate this crisis, avoid the repossession trap, and beat the dealerships at their own game. Strategy number 1, you must completely decouple your financing from your purchasing. The single biggest mistake the American middle class makes is walking onto a car lot and asking the salesman, "What can you get my monthly payment to?" The moment you ask that question, you have already lost. Dealerships make massive profits through what is called dealer markup on interest rates. The bank might approve you for 7%, but the dealer will legally write the contract for 9% and pocket the difference. Before you ever step foot on a car lot, you must go to a local credit union and get a pre-approved auto loan in writing. Credit unions are nonprofit entities, they exist to serve their members, not Wall Street shareholders. When you have a pre-approval check in your hand, you walk into the dealership as a cash buyer. You completely strip them of their ability to manipulate your interest rate. Strategy number 2, do the amortization audit immediately. If you currently have an auto loan, you need to log into your account tonight and look at your amortization schedule. You need to see exactly how much of your $600 payment is actually going toward the principal balance of the car, and how much is just evaporating into interest payments to the bank. If you are underwater, meaning you owe more than the car is worth, you are in the danger zone. You need to pause all unnecessary lifestyle spending and aggressively throw extra cash directly at the principal to build equity before the vehicle depreciates further. Strategy number 3, beware the 84-month trap and gap insurance. Dealerships are trying to hide the massive inflation of car prices by extending loan terms to 72 or 84 months just to make the monthly payment look affordable. Never, under any circumstances, finance a depreciating asset for 7 years. By year 4, the car will require massive maintenance, but you will still be paying it off as if it were new. Furthermore, if you are forced into a long-term loan, they will try to sell you heavily marked up gap insurance in the finance office. Do not buy it from the dealer. Call your standard auto insurance provider, they can usually add gap coverage to your existing policy for pennies on the dollar compared to what the dealership charges. Strategy number 4, know your state repossession rights. If you are currently facing financial hardship and are behind on your payments, do not hide from the bank. Understand your rights. In many states, you have what is called the right to cure. This means the lender must send you a formal written notice giving you a specific number of days to pay the past due amount before they can legally send the tow truck. If they violate this process, the repossession is illegal. Communicate with your lender, ask for a hardship forbearance, but most importantly, know the laws in your specific zip code. The 2026 auto loan crisis is a brutal reminder that the financial system is mathematically designed to extract wealth from the middle class through debt. They want you trapped in a cycle of payments, forever trading your future labor for a depreciating asset today. But you do not have to play their game. Secure your own financing, audit your amortization, refuse the 84-month trap, and protect your capital. If this deep dive opened your eyes to the massive repossession crisis happening right now, hit the like button and share your story in the comments below. Have you seen repo trucks getting more active in your neighborhood? Did a dealership try to trap you in an 84-month loan? I read every single comment to understand what is happening on the ground in your city. To make sure you survive this silent depression and learn how to build real, unshakable wealth, subscribe to the channel right now with notifications turned on. Stay smart, protect your assets, and I will see you in the next video.